Good evening, everyone, and welcome. The weather outside continues to feel like, well, January, and why not? It is January, but inside in trading rooms and on computer screens all across the country, it feels more like November. Specifically, today's closing stock market numbers do. The Dow had its lowest close since November 7th, the S&P 500 since November 12th. Trading was choppy, volatility high. Ongoing worries about emerging market economies and currencies contributed to the slide. And so did a downbeat outlook from the Dow component, Boeing. But the third part of the triple whammy came from the Federal Reserve. Its policy setters announced a further $10 billion reduction in its bond-buying stimulus program. On the day, the Dow fell more than 1% to 15,738. The Nasdaq also tumbled 1% to 4,051, and the S&P said, "Me too, count me in," for 1%. Finishing at 1774. Moving the other way, though, natural gas, it finished at a four-year high, up 10%.
As Tyler just said, the Federal Reserve stuck to its plan to trim back its bond buying program. Wrapping up a two-day policy meeting and Ben Bernanke's last one as chairman of the Fed, the central bank seemed unfazed by the recent upheaval in emerging markets and the stock sell-offs on Wall Street. Hampton Pearson reports.
Neither recent emerging market currency turmoil in Turkey and elsewhere, nor the disappointing December jobs report was enough to get the Federal Reserve to change its mind about trimming its bond buying program. At Ben Bernanke's last meeting as chairman of the Federal Reserve, monetary policymakers were unanimous in their decision to reduce purchases by another $10 billion to $65 billion per month starting in February. Leading analysts were not surprised.
I couldn't see any real way that they would have stopped the process because of some increased volatility in EM and the recent selling in the S&P. It just didn't make a lot of sense.
The economy appears to be a mixed bag for monetary policymakers. On the positive side, growth and economic activity picked up in recent quarters, with both business investment and household spending improving. But there are notes of caution about the mixed job market indicators and a housing recovery that has slowed somewhat in the Fed's view.
This is more of a macro strategy the Fed's trying to employ. I think that they're just trying to get out of the center stage here with quantitative easing and, go back to their traditional monetary policy.
Monetary policymakers say they won't make big moves until there's economic data there to back them up. Janet Yellen officially becomes Fed chair this weekend. The next meeting of the Open Market Committee happens in mid-March. For Nightly Business Report, I'm Hampton Pearson in Washington.
Joining us now to talk more about what's next for the Fed and the U.S. economy is Alan Blinder. He's former vice chairman of the Board of Governors at the Federal Reserve and is now a professor of economics and public affairs at Princeton. Mr. Blinder, welcome and welcome back.
Good to be here.
Is the Fed doing the right thing at the right pace, and can the economy continue to expand even as the stimulus recedes?
Let me take the second question first. The economy can continue to expand. I mean, the Fed is doing what it can with quantitative easing, but nobody, including the Fed, thinks this is of first-order importance in how fast the economy is growing. We're talking, the decimal point or beyond the decimal point. So, yes, it can keep growing with the Fed withdrawing stimulus. Is it doing it at exactly the right time, exactly the right pace? Nobody knows the answer to that. I have to admit to some sympathies with Eric Rosengren, who dissented last time when the Fed started on the grounds they were starting a little too easy. But this is a close call. It's not a very big difference one way or another.
So, Alan, the Fed tapers, which is pretty much what the markets were expecting,
Sure.
And we see that bond prices go up and the stock market goes down. What is that telling us?
It tells me that this is not because of a surprise at the Fed. I think everybody on the planet that follows the Fed was expecting the Fed to say and do more or less exactly what it said and did. So you didn't get any surprise from Constitution Avenue. There is negative economic news, if you interpret it the right way, coming out of the emerging markets. Frankly, as I look at it, and I think as the Fed looks at it, it's hard to see what's going on in Turkey and Argentina and elsewhere as damaging the growth prospects of the United States in any serious way or affecting U.S. inflation in any serious way. So the Fed looks at that and thinks, it's too bad for these countries. It'd be nicer if it was better. but it's not really that relevant to the United States.
I was going to ask you about the emerging markets, but you've already answered it. So I'll turn to the question of inflation versus deflation. Which is a bigger risk right now?
Probably inflation by a very narrow margin. I don't think we're much worried. We have had some episodes in the last several years where deflation started looking like a real worry, and maybe that'll come back, but it doesn't look that way now. On the other hand, inflation is running below the Fed's target, so I don't think they're very worried about, when we say inflation, we usually mean inflation that goes too high. I don't think they're very worried about that right now, at least most of them. The Fed superhawks are always worried about inflation.
Alan, let me ask you that question a different way, because some people have been saying that Janet Yellen, as the new Fed chair, will have to focus more on inflation than on jobs. What is your thought on that?
I don't agree with that. I mean, that could come true if inflation starts rising, right? So inflation's been in the ones. The Fed's target is 2, and the Fed has warned that if it gets over 2.5, kind of all bets are off. But that seems remote. Look, it's not impossible. It could happen, but it seems remote. So I don't think, at least early in Janet Yellen's tenure as Fed chair, she's going to be worried about combating inflation. I think she's going to be more worried about a kind of a soggy labor market, despite the fact that the unemployment rate keeps going down.
Give me a final thought, if you wouldn't mind, on the tenure of Ben Bernanke. What will his legacy be? How will he be remembered?
I think he's going to be remembered for several things. First, saving the economy from oblivion. Now, it got really bad, but it could have been a lot worse without a lot of the creative and imaginative things that the Bernanke Fed did. Secondly, with continuing that imagination, that creativity, you might even call it bravery, because he was getting a lot of criticism, into the recovery period, because it was such a weak recovery, and trying to do very unusual, let's say, and unprecedented things like QE2, QE3, Operation Twist, to try to give the economy some life.
Alan Blinder, thank you. As always, great to see you.
Glad to be here.
Former chairman, vice chairman, excuse me, of the Board of Governors at the Federal Reserve.